Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own but still want to be educated through the process. This is the Monday, June 9th, 2025 edition. Let's get started. We'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. The prior 2-week period, we had a gain of 2.71%, which actually gives us a year-to-date gain of 2.02%. So we finally did it. But yeah, we continue to have our expectations defied. Instead of being in a trading range as we had anticipated, the market is continuing to go up, seemingly unabated. So it's been a very interesting last several weeks for the stock market. Next, we look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. So generally speaking, lower interest rates will lead to higher stock prices, and higher interest rates will lead to lower stock prices. Rates will go up and down on a daily basis for a variety of reasons. And again, our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. On our chart, we've got interest rates listed over here on the left axis and maturity lengths on the bottom from 1 month all the way out to 30 years. The green line is where we ended on June 6th, and the brown line is where we were 2 weeks ago. So very, very small changes. You can see, maybe 6 basis points on the short end and about 10 on 30 year. So not a lot of change on interest rates over the past 2 weeks. There hasn't been a lot of drama leading to significant changes for those rates. All right, as far as recent developments, the stock market ended the month of May with its best monthly performance since 2023. The market was up 6.15% in May, which also made it its best May performance since 1990. There was an old adage of sell in May and go away, which has kind of persisted over the last few decades, but this year it would have been better to hold for the month of May instead of selling. We had trade court judges ruling against a lot of the tariffs that the Trump administration has been trying to put in place. They did appeal that decision, so the tariffs continue while they appeal the ruling, and it's most likely going to end up at the Supreme Court. What would be interesting is if the judge's ruling is upheld and the Supreme Court says that the tariffs are unconstitutional, if they would also be granted relief, and if the Trump administration would have to pay back the tariffs they've collected. If that were the case, then we could see potentially a big increase in the stock market if these companies now are going to get the revenue and earnings back on their books. NVIDIA did report their earnings. They were in line with expectations. The outlook was good. The stock rose, and they are a significant portion of the stock market. So we think they had a lot to do with the positive 2% gain we had over the last couple of weeks. OPEC is the Middle Eastern organization that produces a lot of oil. They're going to increase production. We've seen a pretty significant decline in the price of a barrel of oil over the past year. It used to be somewhere in the low 80s, and even 80 as most recently as January. So over the last 5 months, we've seen a pretty significant drop now. We were close to 60 at the beginning of the month, now closer to $65 a barrel. But if energy costs are coming down, that should be better on our future inflation reports, and should also be good for companies that utilize energy for their operations, and hopefully will have better earnings as a result. President Trump did turn up the dial on steel tariffs to 50%. Elon Musk finished his full-time work at the Department of Government Efficiency. And then while I was out of town, there was a pretty public falling out, which appears to be over the budget bill that's currently being considered in Congress. Tesla stock did see a massive drop on Thursday and then had a small recovery on Friday after it appeared that tensions were easing a bit. As far as the economy is concerned, durable orders were down, not much as expected, but most of the decline was due to commercial aircraft, which tends to be pretty volatile. And since President Trump just had his tour in the Middle East and effectively sold hundreds of Boeing aircraft on that trip, we would expect that the next reading for durable goods will be revised higher. We had personal consumption expenditures, or PCE inflation. That reading came in at 2.1%, 2.147, right? We'll call it 2.15, but they round it down to the nearest single digit following the decimal. So 2.1 for the month. And I mean, we really haven't seen this inflation reading like this in 4 years, right? It was March of 2021 was the last time we saw something that close. And it's been a wild ride since then. But we are hoping that now that we're closer to this 2% level that the Federal Reserve said they're looking for, that they would be willing to make a small reduction in the Fed funds rate, maybe a 0.25% reduction. They have a meeting that comes to a conclusion on June 18th. So we'll have to wait and see what they say. But as far as we can tell, all indications are they will not be cutting at that meeting. We think that would be a mistake. We think a small cut just to give some confidence to the market that they are paying attention and that they're going to give some stimulation to the economy so that it can continue to grow and not wait and make sure that it's headed for a significant slowdown before they do anything. Mortgage applications continued to decline, again suggesting that lower interest rates would be beneficial. We did get a reading on international trade, which pretty interesting. So if we look at gross domestic product, or GDP, right, this is how we measure whether or not our economy is growing or contracting. For the first quarter of 2025, we had significant exports or net exports. So if we look at the value of the goods and services that we import versus what we're exporting, we get net exports. And we, as a country here in the United States, have been importing much more than we export for a long time. There are occasions where we do have a balance or an imbalance that is more exports than we have imports, but by and large, we're importing way more than we export, and that was what we attribute a significant portion of the overall small contraction in the economy to the first quarter. The trade balance came in for the month of May, and it was the smallest we've seen in a long time. And the amount of imports, so the net exports was at 138 billion in April, and that shrank to just 61 billion, so more than half. We saw a decline of imports by 76.7 billion, and our exports are increasing and increased at a rate of 8.3 billion in the month of May. So a lot of that was the front running in March. Like people were scrambling to import stuff before the tariffs went into effect. So we saw this massive import, and again, the end of March was the end of the first quarter. So, the significant imbalance was because everybody was trying to get things in before tariffs were imposed. And now we've kind of gone back to normal import operations. But exports are increasing. They're up 8.6% from a year ago. So we think that there is going to be, or that there are changes in trade policy that have already taken effect. And we're seeing a smaller trade deficit. So if we were to remove the trade deficit that we had in the first quarter, then we would have had a positive GDP print for the first quarter. So we're not expecting that we'll see a negative print for the second quarter. We think that by the end of June, things will be still in relatively good shape. But again, what about the third quarter? What about the fourth quarter? Are we starting to see some cracks in areas of the economy that would warrant a reduction of interest rates? And we think that that's the case. Initial jobless claims are up more than expected. Continuing claims are relatively flat. The payrolls report was better for May than expected. Unemployment is unchanged. Unemployment rate, sorry, at unchanged at 4.2%. Personal income higher than expected. Personal spending was in line with expectations, and job openings were higher than expected in April. There's fewer people quitting jobs, but we are seeing some increase in layoffs and layoff announcements. So again, things are okay. We think that there are areas of the economy that are struggling a little bit, and we would like to have a little bit more confidence that interest rates will be coming down so that we can continue functioning as an economy and continue paying our bills, and that's kind of where we're at as far as developments. All right, for our expectations and implications portion, again, stock markets defied our expectations. We thought it would be trading in this range while we had just above that 5,500 level, and it has continued to rise. A couple weeks ago, we thought maybe we were in a trading range just higher than we had anticipated, and that still could be the case. But with the market, how it behaved over the last couple weeks, we're now at 6,000. We're 2.5% from the all-time highs we hit back in February. So if we have another 2-week period like we just had, we would be setting new all-time highs again. We often will tell clients that we don't control the wind out on the ocean, but we can adjust our sails. So if we're not in a trading range, then we'll continue to ride this out, and we won't tell the market what it's doing or what it should do. We'll just invest according to what we're getting. But our intuition would suggest that we're still going to waver. We're about 30 days from the end of this 90-day delay on the reciprocal tariffs, and if there's no progress, and we think these tariffs are going to go into effect, especially if President Trump feels like he's being threatened by these trade courts and whatever, we're less optimistic that we'll be getting to new all-time highs in the next 2 weeks or 4 weeks, that we'd still expect to see us in more of a trading range. But hey, every day is a new adventure, so we'll see how that goes. Interest rates have remained relatively unchanged. We think that's going to continue, assuming Congress will pass a budget bill of some kind, and we're not worried about the Treasury paying their bills, then we think interest rates will probably stay relatively calm. The futures market does not expect the Fed to cut their Fed funds rate at the end of the June 18 meeting, or even at their July meeting. They're not expecting a cut until September. We think it would be better for them to cut 0.25% here in June, and again in September, and then December, unless more is warranted. But getting these interest rates down to kind of a normal historical level would be appreciated, instead of leaving them at what they consider more of a restrictive level. So we'll see how that goes. But that's kind of it. We're going to maintain our investment allocations as is, and then if we need to make adjustments as needed. But for now, we're just going to continue to ride it out. All right, as a final word, we are getting into the patriotic time of year. We just had the memorial of D-Day here on June 6th. We've got Flag Day coming up. We've got Independence Day in July. Here in Utah, we've got Pioneer Day. So a lot of things to remind us about why we love America, and why we feel like this is the country that provides us with all the opportunities to start businesses and throw out those good ideas and invest in them, and ultimately grow our wealth as a result of these companies being successful and identifying these good ideas. So we love America. We love investing here because we feel like it's got the best setup, the best system for us to capitalize on those opportunities. We also appreciate all of you. We appreciate you sticking with us, and as we are trying to improve our investment strategy and try to do the best we can for you and grow your investments. And that's pretty much all we've got for this week, and we'll see you soon.